Hey everyone, welcome back to Corporate Decoder, the place where we will try to decode the complicated world of mergers, debts, and decades of operational history, all in one financial report. And trust me, this one is a doozy. We are diving deep into Uniti Group, Incorporated's latest quarterly report to uncover what is really going on behind the numbers a story of. Massive change, new debt, and a whole lot of new infrastructure. If that sounds intriguing, make sure you are subscribed because we've got a lot to unpack, and don't forget our Discord community, linked in the description below for more in-depth discussions. This 10Q filing from Uniti Group Incorporated details their financial performance for the period ending the 30th of September 2025. And folks, things have changed dramatically. The biggest story here is the massive merger back on the 1st of August 2025 Unit Group, formerly Old Unit merged with Windstream. This was not a small deal, it was accounted for as what they call a reverse merger, and the numbers are staggering. The total merger consideration was a jaw-dropping $2.3766 billion. This included a mix of stock-preferred, stock warrant, and a cool $370.7 million in cash. This influx of capital is reshaping Unit fundamentally. On the balance sheet, we see a huge jump in assets acquired property, plant, and equipment is now over $8 billion thanks to the merger. Intangible assets also shot up to $1.3524 billion. Goodwill alone jumped from a little over $157 million at the end of last year to a whopping $1.1643 billion. Now, after the merger, this means Uniti paid a substantial premium for Windstream, hoping for future growth and synergies. But here is where things get interesting. Keep in mind that $2.3766 billion merger price tag, they also booked a nearly $1.7 billion gain on the settlement of pre-existing relationships with Windstream. This sounds financially positive, but it's basically an accounting maneuver where they are saying we own parts of each other, so let us settle up and book it as a gain. It's a bit like saying you got paid to clean up your own room. And what comes with a merger of this size, massive debt Uniti now has over $9.2 billion in notes. And other debt outstanding. This is a hefty sum, folks, and it is crucial to understand how they plan to manage it with such a large debt load. They are relying heavily on operating cash flow and the hope that this new combined company will generate enough revenue to service all of this debt, and importantly, that they can access capital markets if needed. Let us look at the income statement for the 3 months ending the 30th of September. These numbers tell a dramatic tale. Total revenues and sales soared to $722.6 million, up from $292.2 million a year ago. That is a 147% increase, driven largely by the merger. However, costs and expenses also exploded from $54.9 million to $765.2 million, a whopping 394% jump. This led to an operating loss for the quarter of $42.6 million, which is a significant reversal from the $137.3 million operating income they had last year. Looking at the 9 months ending the 30th of September 2025 paints a similar picture. Total revenues and sales reached $1.3173 billion, up 51%, but total costs and expenses also surged to $1.0692 billion. That left them with an operating income of $248.1 million, down 44% from the previous year. This illustrates the challenge of integrating such large entities and managing the associated costs. The Kinetic segment, which they describe as their residential business wholesale operations in incumbent local exchange carrier markets, saw significant changes. Service revenues alone jumped to $356.5 million in the third quarter of 2025, with a contribution margin of $1955.4 million. This segment absorbed a lot of wind. D-Stream operations, and the numbers reflect that transition. And then there is the fiber infrastructure segment. Service revenues here decreased by 18% in the third quarter to $234.9 million. This decrease is attributed to lower leasing revenues from Windstream following the lease settlements after the merger. This highlights how the merger interactions are directly impacting segment performance. Now, that $9.3 billion debt load is a major risk factor. They openly admit their indebtedness could materially and adversely affect their financial position, reducing funds for other business purposes and limiting operational flexibility, even after their October 2025 debt refinancing, which involved issuing $1.4 billion in new notes and a new $1 billion term loan. They still carry substantial debt. This refinancing was partly to pay off older, higher interest notes, but it adds up. Another significant risk they call out is cybersecurity. They are highly dependent on their networks and systems, and any breach could disrupt services, lead to data loss, damage their reputation, and incur massive costs with increasingly sophisticated cyber threats. Especially with AI, they are certainly walking a tightrope. And for the investors, the report warns that their stock price may fluctuate significantly. This is due to market conditions, financial results, new products, or competitors and even litigation the concentration of ownership with Elliott Investment Management, LP, and its affiliates owning about 25.2% of the company means they have a huge influence on key decisions, including board, select, yawns which could limit your ability to influence outcomes. So what is the verdict? Unite Group has just undertaken a monumental transformation by merging with Windstream. The financials for the quarter show massive revenue growth, but also exploding costs and an operating loss. This is typical after a huge acquisition, but the sheer scale of their debt, now over $9.3 billion, is a significant concern. Servicing this debt and executing on the anticipated synergies from the merger will be critical. Their future success hinges on effectively managing these new financial burdens and navigating the intense competition and cybersecurity risks. In the telecom industry, the company is betting big on growth through infrastructure expansion, but it is a race against time and the market to prove this massive bet will pay off. Alright, that is our decode of Uniti Group Incorporated's latest filing. What do you think about this massive merger and the company's debt load? Let us know your thoughts in the comments below. If you found this deep dive valuable, please hit that like button and subscribe for more critical analyses of corporate filings, and of course join our growing community on Discord, linked in the description below. Thanks for watching, and we will see you in the next episode.